On June 24th, some of China's largest financial institutions made a sudden move. One after another, banks like ICBC and the Postal Savings Bank pulled the plug on their retail paper gold trading. The official explanation they gave was simple: consumer protection. Gold prices had recently tumbled 28% from their peak, and the government claimed they needed to shield everyday citizens from wild market volatility. To enforce this, regulators drastically increased margin requirements to a record 140%. If you wanted to trade, you suddenly needed more collateral than the investment was actually worth, making it punitively expensive to borrow. But there is a glaring loophole in this protective policy. While the banks shut down leveraged paper contracts, they left the trading and ownership of physical gold completely unrestricted. Restricting one while ignoring the other suggests the risk isn't the volatility of gold itself, but the nature of the paper contracts being traded and the multi-trillion-dollar Western markets they mimic. Western financial hubs like London and New York rely on a highly leveraged system known as paper gold. This diagram illustrates how the market functions. Investors buy a paper certificate that represents a claim on a physical bar of gold. Because the vast majority of traders never actually request physical delivery, the actual metal remains completely untouched in a vault. Once exchanges realize nobody is coming for the actual metal, they can legally write and sell exponentially more paper claims than the physical gold they hold. This diagram shows the direct result of that overissuance. This artificial mountain of paper supply floods the market, which artificially forces the true price of the physical asset down. The Western financial system relies heavily on this illusion of infinite supply. Eliminating paper speculation is the only way to strip away artificial supply and force the market to discover the true price of the physical asset. We are starting to see early cracks in this paper casino. Recently, we've noticed a growing price divergence, where physical metals actually trade at a premium over their paper contract counterparts. Simultaneously, the institutions printing the world's paper currencies are aggressively accumulating physical gold. Central banks, led by China, are buying it up. This chart shows the pace of those acquisitions. They are currently buying over 200 tons a quarter, the fastest rate in recorded history. And as this shaded section indicates, a significant portion of this is undisclosed, meaning the true numbers are likely hidden. While they rapidly increase their gold reserves on this chart, notice the red line dropping sharply. To fund this massive buying spree, these same central banks are quietly dumping United States Treasuries. For the last 5 decades, parking excess wealth in U.S. debt was the unquestioned safe haven for global reserves. China holds hundreds of billions in U.S. debt. They have to execute this sell-off strategically and slowly. If they dumped it all at once, they would instantly crash the value of their own remaining bond portfolios. Central banks are trading the paper promises of the U.S. government for a tangible asset that pays zero interest. This behavior signals a severe collapse in trust toward the dollar. China is constructing a parallel financial ecosystem, one completely independent from Western market manipulation. They are building a dual hub system to make this work. The Shanghai Gold Exchange enforces mandatory physical delivery to establish real, unmanipulated prices. Meanwhile, Hong Kong serves as the accessible international front door for the rest of the world to trade. With this infrastructure in place, global commodity deals can be priced in yuan and firmly anchored by physical gold in Asian vaults. It allows trading partners to bypass the US dollar entirely. This is a direct assault on the dollar's hegemony. How can the United States Treasury defend against it? The US government holds 8,000 tons of physical gold, though it remains hidden on the books behind an accounting rule from 1973. At that time, Nixon fixed the official value at just $42 an ounce, a price that hasn't been updated in over 50 years. At today's market prices, that gold is worth vastly more. By simply updating that official valuation with the stroke of a pen, the Treasury could instantly generate $1 trillion on its balance sheet without issuing a single new bond. The Federal Reserve has actively researched the next step. The U.S. could issue entirely new, gold-backed Treasury bonds to directly rival China's system. China's retail banking ban was just the opening move to clear the way for their own physical exchanges. By removing internal speculation, they are positioning the yuan to settle against the metal itself, forcing the West to choose between defending the dollar's paper promises or matching China's gold-backed reality.